Stop what you're doing for a second, because the silver market just did something that changes the entire game, and most people still don't realize what it means. I'm talking about that psychological 100 level getting smashed and then price not politely backing off, but acting like it's got someplace urgent to be. And if you think this is just another hype spike that fades in a week, I need you to hear the next part, because the real story isn't the headline price. The real story is who's trapped, who's scrambling, and why this move could be the opening scene of a much bigger repricing. Quick note before we get rolling, YouTube's own analytics show a huge chunk of people watch these videos all the way through and still haven't subscribed. If you get value from this kind of breakdown, please hit subscribe, it helps more than you think. Alright, today is Thursday, January 29th, and it is 1039 in the morning New York time. Drop a comment right now telling me what time you're watching this, because I love seeing how global this audience really is. And yes, the description has bonus links, including a premium WhatsApp channel link and a channel membership join link, so if you want the extra stuff, it's waiting for you down there. Now let's set the scene, because the vibe shift around metals didn't happen slowly. It happened like somebody flipped a switch. For a long time, you'd walk into any conversation about silver, and it was the same tired script. It's manipulated, it's boring, it never moves, and miners are a graveyard. Then suddenly the rooms are packed. People can't even squeeze into the back. And the same folks who ignored silver for years are staring at their screens like they missed the first train out of town. I'm not exaggerating when I say you can feel it. You can hear it in the way people talk. The questions change. It stops being, should I buy a little? Or it becomes, how did I not see this coming? That is the emotional pivot point that often separates the early part of a bull run from the middle part, and we might be right on that line. So what's actually driving this move? Before I answer that, let me make a promise. By the end of this video, you're going to understand three things. First, why the move to 100 wasn't the headline, it was the invitation. Second, why the paper price and the street price can drift apart in a way that shocks people who have never tried to source real metal. And third, why the next phase of the story is likely to show up where most people aren't looking yet, inside the stocks, inside the supply chain, and inside the way different regions are starting to tug on price from different directions. And I know some of you are thinking, John, come on, it hit 100, it's already too late. That's the same sentence people said about gold at 2000, about major tech companies when they crossed huge milestones, and about housing before it doubled in certain markets. I'm not saying price can't pull back, it can. I'm saying the phrase too late is usually your brain trying to protect you from uncertainty, not your brain doing math. Here's a quick reality check that most people skip. When silver was stuck under its old ceiling for decades, it created a generation of skepticism. That skepticism is why the rally can keep feeding itself. The market doesn't need new bulls at the start. It needs old skeptics turning into new buyers later, and that conversion doesn't happen at 40. It happens at the moment the chart embarrasses them in public. Now, one more thing before we go deeper, don't confuse excitement in a room with top signal behavior. A real end-of-cycle blow-off usually comes with ridiculous leverage, ridiculous inflows, and people who've never cared about metals suddenly pretending they're experts. From what I'm seeing in the broader numbers, we're not at that stage yet. Interest is rising, but it's not mania. And that is why this phase is so dangerous for people who try to trade it like a quick flip. The move can keep going while you're waiting for the responsible pullback, and then you're forced to chase. So yes, we're going to talk about short covering, but we also have to talk about the bigger backdrop. Electrification, fragile inventories, and the fact that this market is small enough that even modest reallocations can create outsized price moves. That's the setup. And now we can talk about the spark. Here's the simple version. When you get a market where certain players are heavily positioned the wrong way and price starts moving against them, the market turns from a calm lake into a washing machine. That's what a squeeze feels like. It's not just buying, it's forced buying. It's buying that doesn't care about valuation, doesn't care about fair value, and definitely doesn't care about your neat little resistance line. But I also want to be careful here, because one of the easiest ways to get fooled in this space is to blame everything on one single story. It's all a squeeze, it's all manipulation, it's all investors. Real markets don't work that cleanly. There can be a squeeze happening while the macro picture is also pushing money into hard assets. There can be tight physical supply while paper leverage still sloshes around. And that combination, tight supply plus leveraged positioning, creates the kind of price action that makes people feel like the market is broken. Now let's talk about what a squeeze actually looks like in plain English, because this matters. Imagine you borrowed something you don't own, sold it, and promised you'd buy it back later at a lower price. That's the core of a short position. Most of the time, if the price drifts down, you look smart. But if the price climbs, the losses can grow fast. And at some point, especially if you use leverage, someone taps you on the shoulder and says, add more cash or close the position. If you can't add more cash, you're forced to buy. That buying pushes price even higher, which forces more buying. And now you have a chain reaction. And when that chain reaction hits a small market, it doesn't tiptoe, it kicks the door in. Silver is not the biggest market on earth. It doesn't take a huge wave of money relative to global capital to throw it off balance. That's why silver can look sleepy for years and then move like it's possessed. People forget that, then it reminds them. Now let's talk history for a second because context is everything. Silver has spent decades being that metal everyone jokes about. It spiked around the early 80s and again around the early 2000s era peak, and then it spent a long time disappointing people. So when it finally punches through major levels, the move can look impossible to anyone anchored to the old range. That anchoring is psychological, and it's one of the biggest reasons people sell too early. A lot of traders also underestimate what happens after a multi-decade ceiling breaks. If a price level acted like a roof for 40 plus years, it becomes a storyline. It becomes a test of the market's identity. And once that roof breaks, it isn't just price discovery, it's belief discovery. That's why the move can be violent. But here's the catch. A violent move can still be the first inning. That's the part people struggle with. They think big move equals end. In commodities, big moves can also be the beginning of repricing, not just a blow-off. Now let's talk about the part people are whispering about, but not everyone wants to say out loud. For years, a big chunk of the silver trade has been built on promises, paper claims. I own silver, but it's not actually in your hands. It's not even sitting in a box with your name on it. It's a claim on a claim on a claim, and income. Times, nobody cares because nobody asks for the thing. But when prices start tripping, something changes. People start asking questions. People start wanting delivery. People start wanting the real stuff, not the spreadsheet version. And when that happens, every weak link in the chain gets stress tested. If you've ever watched a crowded theater and somebody yells fire, you know the problem isn't the seats. The problem is the doorways. That's what a squeeze is. It exposes whether the system can actually handle everyone trying to get out or everyone trying to get in at the same time, and that brings me to the moment we're in right now. A lot of viewers are asking, is this the end of the old games? Is this the moment silver finally gets a new normal price? Maybe. And one more thing about that new floor question. Floors aren't declared by a price tag, they're earned by time. The market has to chew on a level, trade through it, retest it, and then prove buyers will step in when fear shows up. So instead of obsessing over whether 100 is the floor, watch the fingerprints. Do retail coin and bar premiums stay elevated? Or do they collapse the moment price cools? Do delivery wait times shrink? Or do they stretch? Do big pools of capital keep adding exposure? Or do they back away at the first sign of volatility? Those clues don't tell you tomorrow's price, but they do tell you whether the market is building a base or just throwing a tantrum. And here's the sneaky part. The strongest bull markets feel weakest right after the first big breakout because they frustrate both bulls and bears. If we get that frustration phase next, pay attention. It's often where the next leg is born for patient people, but I want you to focus on a more useful question. What would have to happen for the old pricing system to regain control? Because the reason this feels different is not just the number on the screen, it's the behavior around that number, it's the premium signals, it's the time of day signals, it's where the biggest moves are happening. From recent market updates, you can see that price action has increasingly been dominated during Asian hours, not just the traditional Western session. And when you combine that with persistent premiums in parts of Asia versus New York pricing, it's telling you something important. Physical demand isn't politely waiting for the futures market to allow the price to rise. And this is where things get spicy. There have been stretches where silver priced in Shanghai has carried a noticeable premium versus New York. And the most recent readouts some traders are circulating show a premium that can push into the high single digits or even low double digits at times. That does not automatically mean the West is finished or price discovery moved overnight, but it does mean this. When physical demand is strong enough, it can create a real-world price that paper traders can't ignore forever because arbitrage in metals isn't as frictionless as people think. You can't always just teleport bars across oceans with a snap of your fingers. Logistics, purity specs, local rules, delivery constraints, and inventory all matter. That's why price gaps can stick around longer than a textbook would predict. So does the premium matter? Yes. Is it the only thing that matters? No, but it is one of the cleanest stress gauges we have because it is harder to fake what real buyers are paying to actually get metal in hand. Now here's the cliffhanger. If that premium sticks, it becomes a magnet for physical metal flows. And if physical metal flows tighten elsewhere, the paper market feels it. Not immediately, not neatly, but inevitably. Now if you're watching this and you're thinking, okay, fine, but we already hit 100, isn't this where you take profits and walk away? Here's what I'll say. Selling into strength can be rational. It can also be a mistake if you do it for the wrong reasons. The biggest losses people take in bull markets usually don't come from holding too long. They come from getting shaken out too early, then chasing back and higher, then getting shaken out again. It's death by 1,000 emotional paper cuts, and I can already see it happening. People hit a milestone, their brain screams it's too high. And they sell because the number feels scary, but milestones are magnets. They attract attention, they attract momentum, they attract new buyers who are waiting for confirmation. And when the market is in a squeeze-type environment, milestones can turn into launching pads, not ceilings. That said, let me challenge one popular idea I keep hearing. Manipulation is over. I don't buy that, at least not in the way people mean it. What I think is happening is this: the old tactics get less effective when the fundamental pressure gets too strong. Leverage and games don't vanish, but they can fail to suppress price when physical tightness and forced buying collide. So instead of manipulation is gone, I'd say the cost of controlling the price is rising. Oh, and that's a very different statement, because if someone has to spend more and more to keep a lid on something, eventually, they either give up or they blow themselves up trying. That's the cliffhanger, and we're not at the end of that movie yet. Now, another clue that this isn't some neat little one-week wonder is the scale of outstanding positions. Futures markets can carry open interest that looks enormous relative to the amount of easily deliverable physical metal, and the exchange publishes open interest data you can monitor. Point is not a single number. The point is the persistence of heavy positioning, even after a breakout. When the positioning is heavy, covering isn't always one big day. It can be weeks of messy back and forth where price spikes, pulls back, and then rips again. That pattern is exactly what keeps people glued to the screen because it feels like the market is constantly about to reveal what it really is. Now let's go one layer deeper because there is a second engine under this move that people ignore. Industrial demand. Most folks still talk about silver like it's purely an investment metal. That's a half-truth. It's also an industrial input in a world that's electrifying everything. Solar, electronics, grid hardware, automotive electronics, data centers. Silver touches more of that than most people realize. Recently published numbers have shown industrial silver demand pushing toward record territory with industrial consumption around the 700 million ounce range in a recent year, largely driven by solar and electrification themes. And when you see that, you start to understand why the market can be tight even when investors were quiet for a while. Now, some people will say, yeah, but won't substitution kill demand if prices stay high? That's a fair question. And the honest answer is substitution happens, but it's slower and messier than people think. Engineers don't redesign a whole supply chain because the price moved for a month. They redesign when they believe the price shift is lasting. Even within solar, there have been notable advances that reduced silver loadings per panel, but that doesn't automatically mean total demand collapses because installations can still grow and new tech can change the mix. The net effect can be less silver per unit, but more units, which keeps the market under pressure. And here's the part that should make you pause. The silver market has been flirting with structural deficits for years. In other words, demand has been higher than supply often enough that inventories mattered. And when inventories matter, price becomes more sensitive to surprises. There are forecasts showing total global silver supply around a little over 1 billion ounces in a recent projection with mine output in the mid-800s of millions of ounces and the market still expected to run a sizable deficit. When you combine that with industrial demand that's resilient, you get a setup where paper stress can turn into physical stress fast. Now I'm going to tease something here because it matters for retention. The next big signal is not going to be a headline that says silver is up. You already know that. The next big signal is going to be when people start talking about silver the way they talk about oil in a crisis, like it's an essential input you can't just skip. And when that narrative spreads, the investor demand can follow in waves, which leads us to the question everybody asks right after the price move. Okay, so when did the silver stocks finally catch fire? Let's talk about equities. In theory, miners should be a levered bet on the metal. If silver jumps, their revenue can jump faster than costs, so their margins can explode. That's the textbook, but reality is less clean. First, investors have been burned. For years, miners looked cheap, then got cheaper, so people are hesitant to believe margins will translate into shareholder returns. Second, mining has baggage: dilution, project delays, political risk, surprise taxes, cost inflation. A producer can have a great quarter and still get punished if the market thinks the good news is temporary. Third, the market is waiting for confirmation. Big pools of capital usually don't chase the first move. They wait for earnings, cash flow, and balance sheet strength to show up in black and white. So if you're looking at lagging miners and thinking this rally is fake, that's not the only interpretation. Another interpretation is that the market hasn't priced the new environment yet, and that lag historically can snap. One day it's quiet. Then a few companies report strong results, then analysts revise numbers, then institutions re-rate the space, then you wake up to a gap-up move and realize the easy entry is gone. Now, where should you focus? I'm not going to tell you what to buy. What I am going to tell you how to think. In a metals bull market, you generally have three buckets: the strongest producers, the developers that can become producers, and the explorers that might hit something big. Each bucket has a different risk profile. If you can't handle volatility, should not be pretending you're an explorer investor. Producers are about margin capture and execution. Developers are about permitting and financing. Explorers are about geology and luck. And here's the truth that people don't want to admit: truly meaningful new silver discoveries are rare, not rare like a new restaurant opening, rare like a new giant onshore energy discovery in a mature region. Most of the easy stuff has been found, and what's left tends to be deeper, more complex, and more expensive to develop, which brings us to the supply-response question. People hear high price and assume supply will surge. That's not how mining works. On average, it takes about 16 years for a mine to go from discovery to startup, and that's a global average. In the United States, that timeline can stretch dramatically longer. There are reports putting it at nearly 3 decades on average for new mines, due to permitting and process delays. So if someone tells you, don't worry, higher prices will bring a flood of new supply next year, they're either uninformed or they're selling you comfort. And don't forget depletion. Mines don't last forever, or a grades decline. Underground development gets more expensive, so even when new projects come online, some of that new supply is just replacing what's falling off elsewhere. Now here's another angle that doesn't get enough attention. A lot of silver is produced as a byproduct. That means silver supply is often tied to what's happening in other metals, like zinc, lead, copper, and gold. If those metals face disruptions or low prices that cause mine suspensions, silver supply can get hit indirectly. That's part of why supply can be stubborn even when the silver price is screaming. Now, what about demand in a recession? This is where people get lazy. Yes, some industrial demand can soften if the economy slows, but silver's demand is split and investment demand can surge when fear rises. And silver is small enough as a market that it doesn't take a huge wave of new money to overwhelm available supply. Recently published market summaries have shown total demand in the ballpark of over 1 billion ounces in a recent year, and even with variations in coin and bar buying, industrial usage remains strong, and there's a behavioral twist here that makes silver different. When price rises, it can attract more buying because it signals something bigger is happening. It's not like a car getting more expensive, it's like a signal flare. That's why silver can act like a momentum safe haven in certain phases. Now I am going to add another fresh piece that isn't in the competitor's script but matters. One major gauge of relative value people watch is the gold to silver ratio. In recent market commentary, that ratio has been hovering far above the multi-decade average, which can make silver look undervalued relative to gold in ratio terms. That ratio doesn't predict timing, but it does shape narrative and allocator behavior. Okay, silver's ripping, stocks are lagging, supply is slow, demand is stubborn. So where does gold fit? Gold is the anchor. Gold is the metal that reflects trust or the lack of it. When gold moves, it's not just commodity buyers, it's currency psychology, it's macro hedging, it is institutions trying to protect purchasing power in a world where fiscal math is ugly and geopolitical alliances are shifting. And here's what people miss. Gold doesn't need everyone. It needs a small percentage of massive portfolios to rotate a small percentage of their holdings. That's it. The gold market is not sized for a giant reallocation wave. Now I'm going to speak like a real human here. I don't care what anybody says. The world feels less stable than it did a decade ago and markets price stability. When stability erodes, the demand for insurance rises. Gold is insurance. Silver is insurance with an engine. And that's why the combo can be explosive. Now, I also want to address a hot claim that we are heading towards some kind of monetary reset and gold gets formally reintroduced. Could something like that happen? It's possible, but I don't need that theory to be bullish on metals. The simpler case is enough. High debt, persistent deficits, currency competition, and the reality that real yields can swing negative again if inflation stays sticky while policy gets constrained. Here's another cliffhanger. The most important part of a monetary transition isn't the announcement. It's the drift. It's the slow leak of confidence before the official headline arrives. And you can see confidence drift in one simple behavior: countries wanting their gold closer to home. If a country stores its gold abroad, it's doing it because it trusts the custodian. When that trust fades, repatriation becomes more attractive. It's not always dramatic, and it's not always a sign of panic, but it is a signal. There have been well-known cases where requests to move gold took years to complete, and that timeline alone was enough to spark public debate about custody and availability. The bigger point is this: the moment of public conversation starts around, do we actually have control of our reserves? You've already changed the psychology of the market, and psychology is everything in a monetary transition. Now you've probably heard the phrase resource war or critical minerals race. That's not a marketing slogan, that's a strategy. Countries are waking up to the fact that you can't run a modern economy, especially one that's electrifying, digitizing, and militarizing without secure access to metals, and in some segments, refining capacity matters as much as mining, so which metals matter most? Gold and silver are in their own category, but beyond that, copper, nickel, certain battery materials, rare earths, and specialized inputs are becoming political assets. The list keeps expanding because governments are realizing vulnerability is a national security issue. And if you want a cold dose of reality, here it is. We only have one planet's worth of these resources, and the time it takes to bring new supply online is measured in decades, not quarters. That's why research online lead times keeps hammering on longer development cycles and recurring supply risks. Now, how is the US doing in catching up? I think the US is trying hard, but trying isn't the same as winning. In small markets, you can close gaps faster. But in huge markets like copper or silver, it's much harder to become meaningfully self-sufficient quickly. You can't just snap your fingers and build a full supply chain, especially if permitting and community opposition slow everything down. And even if you open mines, you still need processing and refining. That's the choke point in a lot of critical minerals. The world learned the hard way that having the ore isn't enough if you don't control the midstream. Now let me zoom this back to you and your mindset, because this is where most people mess up. Most investors are trained to think in days and weeks. They want the next catalyst, the next headline, the next pump. But commodities don't usually reward that mindset. Commodities reward people who understand cycles. If you're looking at this metals move and thinking, what do I do tomorrow? You're asking the wrong question. The better question is, what does this look like over the next several years if the structural pressures don't go away? And that's why I keep coming back to one simple idea. You can't predict every wiggle, but you can identify big waves. Population growth, grid upgrades, AI power demand, energy transition build-out, defense spending, supply chain reshoring, currency skepticism. These are not one-week stories. These are multi-year forces. And one say, multi-year force meets a small market. The small market doesn't get to vote. It just moves. Now here's a practical strategy that doesn't get enough love. Build a portfolio, not a lottery ticket. That means you decide what percentage you are comfortable dedicating to the theme, and then you split that across risk levels. Maybe you want some exposure that's liquid and boring. Maybe you want some exposure that's higher risk with higher upside, but you set those buckets up front so you are not making emotional decisions when your screen is flashing red. Because let's be real, the next pullback will feel terrifying. It always does. That's how bull markets steal your conviction. They don't kill you with one big crash. They wear you down with doubt, and don't confuse being early with being wrong. A lot of people were early on metals in previous years and got punished for it. That experience creates scars, but cycles don't care about scars. If the underlying fundamentals are tightening and the financial system is leaning on leverage, the move can take longer than you want and then happen faster than you can react. Let me give you a specific example of how fast this can turn. There are projects on the drawing board that could add meaningful ounces over the next 5 to 10 years, but even meaningful in mining terms can still be small compared to total demand. That's why incremental supply announcements don't necessarily fix a structural deficit. They can help, but they can't instantly rebuild the buffer. Now let me ask you something, because I want you in the comments for real. Do you think we're watching a temporary squeeze that fades? Or do you think this is the start of a lasting repricing of silver and gold? And second question, if silver stocks lag for another few months, would you have the patience to hold through that? Or would you get shaken out? And while you're down there, if you're successful, share your success story in the comments so others can stay motivated. Now, before we wrap, I want to mention something we're doing for premium members, because it's not for everyone, and that's the point. We offer members-only videos produced by a separate team with more research and deeper dives, stuff that doesn't always fit inside a public YouTube video without getting too long. Those videos are only for premium members, and if you want that level of detail, the join link is in the description. Okay, final thoughts. The biggest mistake people make in moments like this is assuming the market owes them a clean narrative. It doesn't. Silver can rip, then chop, then rip again. Gold can grind higher while everyone complains it's boring, and then suddenly jump when nobody expects it. But if this truly is a turning point, if the physical market stress keeps showing up in premiums, if industrial demand stays strong, and if monetary trust keeps eroding, then what we're watching isn't just a rally, it's a shift. And the wild part is, shifts don't announce themselves with a siren. They look like just another move, until you zoom out and realize the old range is gone. So here's the cliffhanger I'll leave you with. If the paper market has been leaning on the assumption that not everyone will ask for the real thing at the same time, what happens? When more people start asking anyway? And what happens when that behavior spreads from silver to gold, and then outward into other strategic metals? If you're successful, share your success story in the comments so others can stay motivated. I'll keep tracking this, and in the next video, I'm going to dig into what to watch next, because the next signal probably won't be the price itself. It'll be the behavior around the price, the premiums, the inventories, and the way money moves. When it senses a regime change, thanks for watching. Take care of yourself, take care of the people around you, and I'll see you in the next one. And just so we're crystal clear, I'm here to share ideas and help you think through markets, not to tell you what to do with your money. This is educational content based on my interpretation of publicly available information, and you should make your own decisions or talk to a qualified professional before taking any action.